a $47 billion dream vanished swiftly. WeWork found itself at the center of this financial maelstrom, having previously attracted truly incredible investment rounds totaling over $11 billion across 6 major funding cycles. The company expanded at an astonishing pace, establishing over 700 locations in 120 cities globally by 2019. Its membership base swelled to nearly 600,000 individuals, representing a 5-fold increase in just 3 years, fueling a projected annual revenue exceeding $2 billion. This hyper-growth phase was driven by an aggressive acquisition strategy and a bold vision for disrupting traditional office real estate. But significant operational inefficiencies were masked by continuous capital injections. The initial public offering process launched in 2019, intended to capitalize on this meteoric rise. However, public scrutiny revealed a different story. Financial disclosures showed substantial losses nearing $2 billion in a single fiscal year, raising serious concerns among potential investors. Governance issues were heavily criticized, specifically highlighting the co-founders' disproportionate control and numerous instances of self-dealing transactions. The proposed valuation consequently plummeted from its peak $47 billion to a mere $15 billion, then rapidly dropped further to below $8 billion, reflecting a dramatic loss of investor confidence. This unprecedented valuation freefall led to the initial public offering's eventual postponement and subsequent withdrawal, sending shockwaves across global markets. SoftBank, the largest investor, was forced to intervene with a truly massive $750 million rescue package to prevent immediate bankruptcy and ensure the company's short-term survival. The aftermath necessitated a painful restructuring, involving extensive layoffs, affecting more than 8,000 employees, a reduction of nearly 1/3 of its entire global workforce. Dozens of underperforming locations were strategically closed as management shifted focus towards core profitability and operational stability. Non-essential ventures such as We Live and We Grow were divested to streamline operations and reduce mounting expenses. The company aimed for a more realistic $1 billion valuation by 2021, striving to rebuild investor trust through responsible fiscal management. Despite the dramatic setbacks, WeWork still retained a substantial international footprint, with over 500 co-working spaces spread across 38 countries, serving hundreds of thousands of active members. The journey from celebrated disruptor to cautionary tale underscored the critical importance of sustainable business models and robust corporate governance within the high-stakes world of technology startups. Its future remains a complex challenge requiring sustained efforts towards efficiency, market adaptation, and strategic growth without the previous unchecked ambition. The sheer scale of its rise and fall is truly remarkable. $47 billion just vanished. WeWork faced an unprecedented crisis following its spectacular fall from grace, a situation demanding immediate drastic action and a complete overhaul of its previous unchecked ambition. SoftBank, the primary investor, had to intervene with a truly massive rescue package totaling $750 million to prevent the company's immediate bankruptcy and ensure its short-term operational survival. This financial lifeline was a desperate measure to stabilize a rapidly spiraling situation. The aftermath necessitated a profoundly painful restructuring process, affecting every layer of the organization. Over 8,000 employees found themselves abruptly without jobs, representing a staggering reduction of nearly 1/3 of its entire global workforce. Dozens of underperforming locations were strategically closed as the new management team shifted its core focus towards achieving sustainable profitability and establishing robust operational stability across its significantly pruned portfolio. Non-essential ventures like We Live and We Grow were swiftly divested to streamline operations and drastically reduce mounting financial expenses. The explicit aim was to move away from diversified ventures and concentrate solely on its primary co-working business model. WeWork set a new, more realistic $1 billion valuation target for 2021, striving to rebuild crucial investor trust through responsible fiscal management, transparent corporate governance, and renewed fiscal prudence. Despite these dramatic setbacks and immense public scrutiny, WeWork remarkably still retained a substantial international footprint. It continued to operate over 500 co-working spaces, spread across 38 countries, serving hundreds of thousands of active members worldwide, proving its underlying core concept held resilience. The arduous journey from celebrated industry disruptor to a stark cautionary business tale profoundly underscored the critical importance of sustainable business models and robust corporate governance within the high-stakes world of technology startups. Its future remains a profoundly complex challenge requiring sustained efforts towards greater operational efficiency and keen market adaptation, and fostering strategic growth without the previous unchecked ambition. The path ahead demands a complete departure from the former hypergrowth strategy, focusing instead on meticulously measured expansion and long-term viability. Rebuilding trust with both its remaining investors and its active members is absolutely paramount for its continued existence. The sheer scale of its original meteoric rise and subsequent cataclysmic fall remains truly remarkable, serving as a potent lesson for the entire global industry. This unprecedented saga taught many companies the harsh realities of unsustainable growth and the vital role of sound financial principles. A single departure payment dwarfed the annual earnings of thousands. WeWork found itself navigating treacherous waters after its precipitous decline, a stark test of survival. The new leadership faced an unenviable task to stabilize a company but had lost its way amid a dizzying chase for infinite expansion. Over 500 locations across 38 countries still existed, yet many were bleeding cash at an alarming rate. Membership numbers, though in the hundreds of thousands, had begun to plateau, reflecting widespread market wariness. Investors, especially SoftBank, who had already poured in over $19 billion, were demanding a clear path to profitability, a stark contrast to the previous burn rate of multiple millions each month. The ambitious $1 billion valuation target for 2021 now seemed like an Everest summit without proper gear. Operational costs were aggressively trimmed, leading to further rounds of layoffs, impacting another several hundred employees, bringing the total reduction to well over 9,000 individuals since the crisis began. Non-core assets beyond We Live and We Grow were also stripped away, including holdings in numerous tech startups and a private jet once symbolizing its former excess. This desperate move aimed to free up another $300 million in capital for core business investment. Rent renegotiations with landlords became a daily battle, attempting to cut expenses by as much as 25% across its most expensive properties in major cities like New York and London. The company's brand reputation took a significant hit, with news outlets frequently detailing its corporate governance failures and the extravagant spending of its former founder. Restoring this faith became a paramount mission, a multifaceted challenge requiring years of consistent, transparent action. New strategic partnerships were sought with major corporations offering bespoke office solutions aiming to secure long-term, high-value clients. Technology upgrades were also initiated to improve member experience and operational efficiency. A $500 million investment over 3 years. Despite the immense challenges, the fundamental demand for flexible workspaces persisted, driven by evolving work patterns and a growing gig economy. WeWork still commanded a vast market share, albeit a significantly diminished one. Its recovery was predicated on demonstrating genuine fiscal discipline and a tangible return on investment. The company was forced to confront its past hubris, a painful but necessary journey towards sustainable operations. Every decision was scrutinized under a magnifying glass, with the weight of hundreds of thousands of jobs and billions of dollars in investor capital hanging in the balance. The path to redemption was long, arduous, and fraught with potential pitfalls, a complete reimagining of its original disruptive vision. This meant a shift from rapid expansion to meticulous optimization, focusing on member satisfaction and financial health. The future hinged on its ability to prove its enduring value proposition without the previous artificial hype. It had to earn its place back, one cautious step at a time. The real work of building a resilient business foundation had only just begun. Its journey continued through a landscape of heightened competition and economic uncertainty, demanding relentless adaptation.